and welcome back to a brand new episode of Money Matters. I'm your financial empowerment coach, Denai Wolfe. Today, we're diving deep into the world of credit and credit scores, unveiling the secrets to building a strong credit history and understanding the factors that shape your credit worthiness. So if you're ready to take control of your financial destiny and unlock the doors to better opportunities, stick around because we've got a wealth of knowledge to share. Let's face it, the idea of credit scores can be overwhelming and confusing, but trust me, it's important to understand how they work and why they matter. Your credit score plays a crucial factor in many aspects of your personal finances, including loans, credit cards, and mortgages. So what exactly is a credit score? Well, in simple terms, your credit score is a 3-digit number that represents your credit worthiness. It essentially tells the rest of the world how likely you are to repay your debt and pay your bills. It shows your credibility and how well you handle responsibility. It's used by lenders, landlords, and even some employers to evaluate your financial responsibility. The higher your credit score, the better your chances of getting approved for loans, credit cards, and other financial products. Credit scores range from 300 to 850, with the average in the US being around 700. So why does it matter? Well, your credit score can affect many aspects of your life, from getting approved for a loan or a credit card to renting an apartment, getting a mortgage, and even getting a job. It also impacts the interest rate that you pay on your debt. The lower your credit score is, the higher your interest rate is going to be on your debt. In short, having a good credit score can make your life easier, while having a bad credit score can make things a lot more difficult for you. Your credit score is based on several factors, including your payment history, the amount of debt you owe, the length of your credit history, and the type of credit you have. Here's a breakdown of each one of those factors. Your payment history. Now, this is the most important factor in your credit score, so pay attention. Lenders want to see that you make your payments on time every time. Late payments, collections, and bankruptcies can all have a negative impact on your credit score. They're also looking for the amount of debt you have. Lenders want to see that you're not overextended. If you owe a lot of money relative to your income or credit limits, it can be a red flag. This is why it's important to keep your credit card balances low and to pay off your debt as quickly as possible. Now, your credit score also takes into account your length of credit history. The longer your credit history, the better your score. Lenders like to see that you have a track record of responsible credit use. This is why it's generally a good idea to keep your oldest credit card open, even if you're not regularly using it. Now, the credit bureaus also look at the type of credit you have. Lenders like to see that you have a mix of different types of credit. This can include credit cards, car loans, mortgages, and personal loans. Having a diverse credit portfolio shows that you're able to manage different types of credit responsibly. So what can you do to improve your credit score? Well, here are a few tips. Number 1, make your payments on time every time. This is the most important thing you can do to improve your credit score. Number 2, pay down your debts. If you owe a lot of money, try to pay it off as quickly as possible. This will lower your credit utilization ratio, which can help improve your credit score. You also want to be sure to keep your credit accounts open. As I mentioned earlier, the length of your credit history is an important factor in your credit score. So keeping your oldest credit accounts open can help improve your score over time. Now, you also want to make sure that you don't apply for too much credit at once. When you apply for credit, the lender actually runs a hard inquiry on your credit. Too many hard inquiries can lower your credit score. You also want to monitor your credit report regularly. You're entitled to one free credit report from each of the 3 major credit bureaus each year. Reviewing your credit report can help you spot any errors or fraudulent activity. I personally use the free app Credit Karma. I keep it on my phone and I check my credit score often. Not only is this a good way to stay in the know about your score, but it's also a great way to ensure that you don't have anyone stealing your identity and purchasing things in your name. By following these tips, you can improve your credit score over time. And remember, having a good credit score can open up a world of financial opportunities for you. Now, you might be watching this thinking that you're not suffering from bad credit, you just simply have no credit at all. And building good credit when you have no credit history can seem a bit challenging, but it's definitely possible. So here are several steps that you can take to establish positive credit if you have no credit. The first thing I want you to do is open a bank account. You can start by opening a checking account or a savings account if you haven't already. This will demonstrate financial stability and provide a foundation for all of your other financial activities. Currently, TD Bank offers an essential checking account. This is perfect for first-timers as it has very low fees. You also want to apply for a secured credit card. A secured credit card is a good starting point for building your credit because it requires a cash deposit as collateral, which usually becomes your credit limit. Using the card responsibly by making small purchases and paying the balance in full each month will improve your credit score and help you build credit and have a positive credit history. TD Bank offers a cash secured credit card, and what I love about this card is they actually give you 1% back on certain purchases, which means they literally pay you to use the card. So imagine that, getting paid to build your credit. It's a win-win. Now, if you become an authorized user on someone else's card, a close family member or a close friend who has good credit, it will actually help you improve your score. Their positive credit behavior will reflect on your credit report, therefore benefiting and increasing your credit score. You could also apply for a credit builder loan. Some financial institutions offer credit builder loans specifically designed to help individuals build credit. These loans typically have low borrowing amounts and may require you to make regular payments over a specific period. But if you successfully pay them back, the loan will help you establish a positive credit history. You also want to hone in on the bills that you pay on time. Consistently paying your bills such as rent, utilities, and phone bills are not directly reported to the credit bureau. However, some alternative credit reporting agencies consider these payments when calculating your creditworthiness. You could also sign up for services such as Experian Boost or Ultra FICO, which allow you to include your utility and telecom payments in your credit history. You also need to make sure you keep your credit usage low. If you have a credit card or a line of credit, you don't want to exceed more than 30% of the total credit available to you. Using a high percentage of your credit limit can have a negative effect on your credit score. So aim to keep your credit utilization ratio as low as possible to help you maintain a positive credit standing. And as we've said before, when building your credit, you want to monitor it, regularly checking your credit reports from the major credit bureaus to ensure that there's no errors or fraudulent activities. You can also head over to annualcreditreport.com in order to check out your score. Remember, building your credit takes time. You want to be patient and responsible. You need to make sure that you consistently practice good credit habits, such as paying bills on time and keeping debt levels low so that you can avoid unnecessary credit applications. Remember, it's going to be a gradual process, and it might take several months to establish a solid credit history. But by following these steps and being responsible with your financial activities, you can gradually build a positive credit profile. Now, that concludes today's episode, but be sure to join us the next time on Money Matters as we continue to explore the world of personal finance. And if you're looking for more tips on personal finance, be sure to like, subscribe, and follow me on Instagram at The Chic CFO.